Pooja Thakur, and I, Saili Zog, kindly extend our warm greetings to everyone present here, especially to our Honorable Chancellor, Vice Chancellor, and the esteemed panel members of today's discussion. As we are all aware, the Institute has had the honor of hosting the Reserve Bank of India Chair Professorship for several years. The chair aims to support policy making through rigorous research and promote advanced learning at the Institute in the fields of monetary and financial economics, banking, and other areas of relevance to the Reserve Bank of India. Today's panel discussion on Navigating the Financial Stability Report, June 2025, marks the inaugural event for the academic year 2025-26. The Financial Stability Report is a biannual publication of the Reserve Bank of India. It provides a critical assessment of the performance of various financial segments and highlights the risk confronting the macro financial systems. The report serves as a vital resource for citizens, cautioning them about the potential risk and helping consumers, savers, producers, and foreign investors stay informed about the evolving dynamics of the macro financial systems. We are pleased to inform that the current RBI chair professor at the Institute, Dr. Rabin Mishra, was the founding head of the Financial Stability Function at the Reserve Bank of Edition, offering valuable insights to students and faculties on various issues of the Indian microfinancial systems.
Thank you, Dr. Pooja. It is now my singular pleasure to introduce our distinguished speakers for today. To begin with, I would like to request Shri Sanjeev Sanyal, our Honorable Chancellor of the Institute, to please join us on stage. At Sri Ram College of Commerce and pursued further education at St. John's College, University of Oxford as a Rhodes Scholar. Sir began his professional journey in the financial markets in the mid 1990s and rose to become the global strategist and managing director at Deutsche Bank, a position he held for 2 decades until 2015. His contributions have been widely recognized. He received the Eisenhower Fellowship in 2007 for his work on urban dynamics and was named a Young Global Leader by the World Economic Forum in 2010. In 2014, he was honored with the inaugural International Indian Achievers Award for his literary contributions. An accomplished author, Sir has written several best-selling books, including Land of the Seven Rivers, The Indian Renaissance, and The Ocean of Churn. Please join me in welcoming Sir. We are also joined today by Professor Ashima Goyel. Ma'am, can you please join us on stage? Ma'am is an emeritus professor of economics at the Indira Gandhi Institute of Development and Research, Mumbai. She is widely recognized for her expertise in open economy macroeconomics, international finance, governance, and development economics. Her research spans macroeconomic dynamics, general equilibrium, monetary policy transmission, inflation targeting, and fiscal monetary coordination in the Indian context. Her recent work also includes fiscal federalism and India's exchange rate regime under inflation targeting. Professor Goyel has served on numerous boards and high-level policy committees, including the Monetary Policy Committee of the Reserve Bank of India, contributing directly to national policy formulation.
We also have with us Dr. Rabin Mishra, RBI Chair Professor at the Institute, who brings over 4 decades of experience at the Reserve Bank of India. With a PhD in economics and a postdoctoral fellowship from Harvard, he has held several leadership roles, including Executive Director of the Reserve Bank of India and Founding Director of its College of Supervisors. Dr. Mishra has served on the boards of major financial institutions and international regulatory bodies with expertise in macroeconomic policy, financial regulation, systematic risk, and governance. He is also a published author with his latest work focusing on macroprudential regulation. We welcome you, sir. We are equally honored to welcome Mr. Ayapan Nayer, General Manager in the Financial Stability Department at the Reserve Bank of India. He is one of the primary authors of the biannual Financial Stability Report. Mr. Nair has 25 years of experience in the central banking and has served as a bank supervisor at the Reserve Bank of India. He was also a faculty member at the Reserve Bank Staff College, specializing in central banking, financial regulation, and financial markets. He holds an MBA in finance, is a certified financial risk manager from the Global Association of Risk Professionals USA, and Master of Management Studies in Systematic Risk from the Yale School of Management. Please join me in welcoming, sir.
Last but not the least, we would like to welcome the moderator for today's session, Shri Rahul Ghosh, a seasoned banking and risk management specialist with a deep expertise in credit risk, market risk, enterprise risk, and financial technology. Over his illustrious career, he has advised more than 2 dozen banks, 4 dozen corporates, and the Saudi Central Bank on risk consulting and audit matters. He is the author of two noted books, Basel Interest Rate Risk in the Banking Book and The End User's Guide to Risk Management and Derivatives. His insights into real world risk management failures have been featured in the Harvard Business Review online and at IIM Ahmedabad. Shri Ghosh also leads an annual executive development program in India, training senior bankers in advanced topics such as Basel Capital Framework and quantitative finance. I request you to join us on stage, sir. I would now like to request Professor KS Hari, Dean of Research, to kindly join us in felicitating and welcoming our panelists. Come forward.
मैं तो यही कहूँ आशिमा जी अपन जी को दिखाए हम लोग को फेलिसिटेट क्यों कर रहे हैं
Thank you so much, sir. Before we begin with today's proceedings, I have the pleasure to announce the official release of a report by the Center for Sustainable Development titled Human Wildlife Conflicts, an estimation of net agricultural losses in Maharashtra. I would request our Vice Chancellor and Professor Nulkar to please join us on stage for the release.
Lots of
Thank you, sir. I would now request Shri Rahul Ghosh to kindly commence with today's proceedings. Sir, over to you.
Thank you. In the financial stability report just released is the latest one. And the Financial Stability Report, let me call it FSR, because it will be a term which will come repeatedly. And it's a biannual report. Last several of our FSRs have been released during challenging times worldwide and in India. And here we are still, India. So there have been global wars for several years, and these wars have been in geographies of the world where a lot of commodities come from, oil, critical minerals, minerals that go into agricultural inputs. So these are all very critical and inflation stoking areas. And now we also have trade war. And in terms of domestic stability, we have still seen enormous stability as a for most ordinary Indians, and I'm sure most people present here certainly would not have noticed, life disrupting changes in prices of oil or food like people in other countries have experienced, including in Western Europe, nor in manufacturing goods. Our growth rate has remained phenomenal, the fastest among the large economies in the world. We have also, at the same time, this keeps switching off. Yeah, and these difficult years have also coincided with enormous banking sector reforms, which is phenomenal. And banking sector reforms in various areas, from cleanup of the NPAs, improvement in risk management standards. And for those of you who are not familiar with risk management standards, this today forms the very basis of banking in terms of auditing, in terms of credit granting, how credit is granted, not based on the subjectivity of a bank officer, but through very channeled systems and processes laid down. And all these banking reforms have also happened during the same time, while we have been juggling international issues, domestic growth rate, but which, and that's what we want to hear from our panelists. Probably we have been juggling and also pedaling our cycle bicycle faster on an uphill road. So there have been immense investments in infrastructure, agri efficiencies built into the various government processes down to the citizens' various services. And today, if you when you read the FSR June 2025, you will find while we are growing phenomenally, the tone is of optimism, but there is also caution. We have supply chain risks and so on and so on. But the overall theme is, after reading it, one finds of resilience and growth, and we are still being the leader. So my those are my opening remarks, and I'll request Dr. Sanal to provide the first set of opening remarks. And after that, the first set of opening remarks are done with the panelists. I will pose certain questions. I'll interact with the panelists with certain questions on your behalf before we open it for Q&A.
So let me say that we'll keep this more chatty rather than giving opening statements. So I'll make very quick observations, and everybody can give their observations, and we can get a conversation going. That's much more fun. So let me say that, the world is always uncertain. There's always shocks happening. Today there is maybe discussion about the Trump tariffs, but there has never been a time ever in history where there's no shock happening. So this idea that we live in an uncertain terms actually an oxymoron, because it's always be the case. If I went back 5 years back, we were in the middle of COVID crisis, and I can assure you it looked much worse than now. And if you go back another 5-10 years from now, there was a global financial crisis. If you went back 5-10 years before that, you would find the Asian crisis. Or you went back another 10 years, the Soviet Union had collapsed and we were in a crisis because of the 1991 reforms. So the world is always in some flux. So we shouldn't get too thrown off by the turbulence we are seeing now. As turbulence goes, this is not too bad, actually. In fact, since this is not so much about growth, usually the discussions are about growth. But since this panel is really about stability and financial stability, but more generally macro stability, let me say that India probably right now is enjoying an unusual period of stability. You can debate whether it should grow a little bit faster, but on a stability perspective, it's doing exceptionally well. Our inflation is running at around about 2%. At the bottom, if anything, of the range. So in fact, some people would argue a little bit more inflation may actually be okay. External accounts are in good shape. The fiscal balance is clearly and steadily coming down. And since this is about finance, our banking system, after lots of ups and downs, is very well capitalized. The NBFCs, but specifically the banks, are in very good shape. One could argue they should be probably lending at a faster pace, but that's again a different debate. But from a stability perspective, we are actually, by any standard, in an unusually good place. Now, this is not to suggest it hasn't been difficult to get here. A lot of hard work has happened over the last decade. In fact, all members of the panel have had some role or the other in anchoring inflation, cleaning up the system, improving supervision, and so on. And so I think there might be some interest in how we got here. And then to also think about a question maybe others can think about, are we becoming too stable?
Yeah. So, Dr. Goyel.
Thank you. Yes, I agree with the theme that we are extremely stable and resilient. Repeated shocks, but we are doing well, being too stable despite the shocks. But what I want to flag is how surprised we are at how stable we are, or especially for the financial sector. Because through the 2010s, as banks were in bad shape, it was thought that the pandemic would throw them out even more. And so many analysts, the World Bank, the regulator expected things to get worse, but it improved remarkably. So what is the reason for this? And I think that it's a metaphor not only for the financial system, but for the economy also. It's if you have a deep pond, somebody throws stones, it's not going to create big ripples. So the complexity and diversity of our economy has increased. Of course, there were the normal and of the financial system. We are still bank dominated, but there are a number of other types of institutions and instruments available now. And overall, this makes for a more stable system. Our banks were really pressured to lend for infrastructure, and there's a set liability mismatch. Now you have other ways to lend to the boom in infrastructure that's going on in the economy. And of course, the normal improvement in governance, in improving incentives for the financial sector. We had a sunset clause in the liquidity that was pumped in, so people don't get used to excess liquidity. So attention to incentives, prudential regulation. I think these are some of the issues I'd like to flag in the opening.
Thank you very much, Dr. Mishra. If you can have.
So since many of the audience are the students, so certain things which will be required to be understood during the course of the discussion, I'll clarify in the beginning. As Chancellor told, like contribution of regulation and supervision to the kind of stability they are talking. And regulation and supervision, curiously, are synonymously used by journalists and others. But there is a difference there, especially in Indian context. Regulation is a response to periodic changes in the macro financial system. And supervision is, as per Indian Act, anything that is detrimental to the interest of the depositors. The supervision has the powers to do, in addition to also seeing whether these regulations are being adhered to. So there is a huge power in supervision. And two major things which we are special in the world. We are the Vishwaguru, which I had written and Governor has read out in this speech here. In regulation is one. We are one of the first to be going away from being sector agnostic regulators. We are sector specific regulators. Simply put, suppose there is a problem in real estate sector. So earlier when I was like you, we used to say RBI doesn't bother about sectors. We used to go by for the economy. Now RBI doesn't say that. It tries to address that problems of that sector straight away. That is called sector agnostic versus sector specific. And in supervision, and this has given rise to macroprudential regulation in the sense, a sweet hybrid of the monetary policy instruments, regulation instruments, and the intense supervisory content is called macroprudential regulations. So the revised edition of my book is coming in next 1 month. So which is a course book in Yale University where he studied. So that will answer many of those things. But that is the beauty here. India is the mother of macroprudential regulation, not Spain. So we are the mother of sector specific regulation. And we are also the pioneer of a supervisory system which is pre-mortem, not post-mortem. Till now, supervision is done after the balance sheet is published, but we have started asking questions so that in next 3-4 years, we will not go after the year. So round the year, we will ask questions about what is happening. So, and this is definitely better. A pre-mortem kind of supervision versus a post-mortem kind of supervision. So this is our contribution to my understanding. Bank of Canada, I had a speech there last year. They are also using this, and which is prominently told by Governor Das throughout his career in this unsupervision, smelling distress in advance, so that we create distress immune and future ready institutions. I will stop here, and that defines resilience. I will come little later. So we are clear on regulation and supervision. So supervision is all intensive. Regulation is sector specific.
Thank you, Dr. Mishra, and Mr. Nair, invite you.
Thank you so much for the invitation. Extremely honored to be part of this distinguished panel. Because I work in Reserve Bank of India, I have to apply the usual disclaimer. These are my own views. They do not represent the views of the RBI. As Shri Sanal said, we have always been in the midst of uncertainty, which, as somebody who writes financial stability report, is the best thing to happen, right? There are a lot of material that is readily available for us to look into. But the stability that we talk about, and I think what Mr. Sanal echoed is a constant theme that I'm hearing across within Reserve Bank of India and outside, is that are we too stable for our own comfort? So sometimes when we do the report, we keep looking at the numbers and just making sure that we are not missing out anything. But the bottom line is, as I tell most of my colleagues, that it almost took 10 years to clean up the bank balance sheets. See, typically banking crises are pretty prolonged, and they have a lot of important ramifications for the real economy. And it took us 10 years. What we started in about 2015-16 with the cleaning of the balance sheet through asset quality review, it has taken an enormous amount of time to clean up the entire system. So sometimes when we look at the banking system and we think that everything is stable, okay, can we let our guards down? It is always something that has to be at our back of mind, that once the genie come out of the bottle, it's extremely difficult to put it back. It takes enormous amount of time and effort. So the financial stability report is in an effort to trying to put together some issues that we see. We typically look for vulnerabilities because we can't identify shocks. So your COVID is a shock, your Israel-Hamas war is a shock, and I nowadays joke, Mr. Donald Trump is a daily shock. Right? So we can't predict those shocks. But what we try to do is we try to build a resilient financial system. What I mean by resilient financial system is essentially you're trying to reduce the vulnerabilities in the system. So we don't want to have vulnerabilities, right? So if you are vulnerable, then what happens is when a shock hits, you amplify the shock. If you are less vulnerable, then you absorb the shock. And this is exactly what happened between 2013 taper tantrum vis-a-vis the 2022 Russia-Ukraine war, right? In 2013, we amplified it because we had a lot of vulnerabilities. In 2022, we had reduced all those vulnerabilities, and that has helped us. So financial stability report it's like crying wolf, and then we have to keep on crying that so that all the stakeholders remain attuned to what all is happening, which keeps the system stable. And as Mr. Sanal said, probably we can have a discussion on as we go along whether is too much of stability is a good thing or not. I'll stop it here.
Thank you. Financial crisis is exactly the what the opposite of financial stability. And in 1997, when we had the financial crisis in Southeast Asia, so much was written, so many different books were written. And one of the most outstanding piece of work that I saw, distinct piece of work that time, was a book written by a expert on banking and credit risk, Philip Delazy, a Belgian banker who had founded a credit rating company. And he explains the entire financial crisis through the balance sheet of the banks, that says that whatever is happening in economy at a point in time is already reflected in the balance sheet, and what you have to look at. And if the balance sheet is not healthy, then the economy cannot be. So if we are here today and stability is there in a world which is extremely turbulent, there has to be something about the bank, and we already know that a lot of major effort went in the last 7, 8, 10 years in terms of bank cleanup, and there are two actors in that: the RBI itself, and then the government side, the Ministry of Finance. And that we have Dr. Sanal here. Let's ask from the father of the bride himself on how exactly that financial, that banking sector health was regained.
Thank you very much. So that since there are students here, let me give you some idea why the financial sector is important. So the financial sector is like the circulatory system of a human body. So the circulatory system of the human body takes oxygen to all parts of the body to keep the body functioning. In the same way, the financial system takes capital and circulates around the body. Now, a financial crisis is therefore like a heart attack. So if you have a heart attack, it doesn't matter how good muscles are, how good your brain is, how good your eyes are, the whole system jams up and literally run the risk of it dying. So financial crises are bad for exactly this reason. And once you have it, it takes a long time to recover from it. So what happened is that when the big financial crisis happened in 2007, 2008, it happened in the West. We were not the direct focus of it, but it slowed our economy down very sharply. And the economic managers of that time took the view that let us try and reinflate the economy. So what they did as a result was pump up the financial system and pump a huge amount of excess lending that happened. And inevitably, when we overdo lending, some part of it goes bad and it accumulates in the system. And so there was a huge pumping up of lending in 2008, 9, 10, 11, 12, 4 or 5 years. And a lot of it got misallocated. The result of is that 2015, 14, 15, the financial system we could feel was going through a heart attack. And you will remember India was then listed as a fragile five and so on. There were many twin balance sheet problems and many other problems, but the root of the problem was that the financial system had overpumped and then basically began to have a heart attack. So that is the juncture in which steps began to be taken to clean up. So around about 15, 16, 17, a asset quality review was done to find out what is the condition of the banks. Now, by end of, I think it was 2016, we knew that the situation was bad. But the question then arises, what do you do? Now, what is happening here is by this time we knew that a large number of non-performing assets had accumulated into the system. So think of this as cholesterol that's going into the veins and is jamming up the arteries. So, you know, even the heart is pumping, this banking system is gridlocking as a result of this. And by the way, it was also beginning to spread into the non-performing, non-bank, NBFCs, non-bank financial institutions. So banks had a problem, now non-banks also. Now it's all gridlocking. So now, this is beginning of 2017, I've just joined the finance ministry. And this is the live topic of the day. So on my first or second day, the then finance minister, Arun Jaitley ji, called me into his chambers and said, Sanjeev, you are the only person in this building who's actually worked in a bank. So therefore it is your problem. So now, since I was the person sort of look into researching it, I looked into the matter. Now, at that time, the conventional wisdom, I don't know if the RBI, but certainly in the finance ministry, was that we should create a bad bank. So what is the idea behind the bad bank? So you take out all this cholesterol and the gross NPAs, stick them in another entity called a bad bank, and we'll fix it in some fashion. Meanwhile, you infuse the system with some capital. So at least the banking system continues instead of having a heart attack. It's like basically saying you'll go in there, pull out some of the cholesterol, put it into something, pump some new blood in to keep the system going. Think of it that way. So this was what the mainstream thinking was. Now, I had a different view on the matter. My view was that if you did this, you would actually perpetuate the problem because you see, like the human body, you can take the cholesterol from one place, but you can't throw it out of the system, right? The economy is still closed. So all you'll do is take the cholesterol from one place and put it somewhere else where you'll have a heart attack. In fact, we have a long history of doing bad banks. We used to have something called BIFR. And basically BIFR was a warehouse where bad assets were put. They would fester there for decades based on, and taxpayers' money would be continuously used to keep them alive. And very often the same entrepreneurs would be in charge, the promoters would keep siphoning off money. It was not going to solve the problem. So I was a little uncomfortable with this. So I came up with I went back and say, sir, why don't we use the insolvency and bankruptcy code to clean up the bank? Now, insolvency and bankruptcy code had just a few months ago been passed. And I said, let's bankrupt some of these companies, liquidate them, sell off the assets, let's see what happens. Now, the main objection to this was that, look, there are lakhs of crores of assets. This system has never been tried before. The NCLT courts have never been tried. How are you going to clean up these banks? So somebody said, why don't you try at least a few small cases and we'll see what happens. So I went back to the drawing board and I made a slide. There was a friend of mine who was in the banking analyst at that time who helped me do this. And I made the following discovery. The discovery was this, that although there was a large mountain of bad NPAs, 50 cases accounted for 2/3 of the problem, 50 cases. And 12 cases accounted for 30% of the problem. So I went back and presented this to Jaitley ji, that even if it is a completely new NCLT system, surely it can do 12 cases. No matter how bad and new the system is, 12 cases. Secondly, there is no correlation between the complicatedness of a case and and how large the case is. Most of these cases are actually steel companies and rather simple. So I made the case that let us use the insolvency and bankruptcy. Now, obviously, this was still quite contentious idea, but I have to say I got a lot of support from various people. There was a Dr. Sahu in IBBI, Insolvency and Bankruptcy Bureau of India. He was very supportive. It's a new body at that time. He was very supportive. There was a banking secretary, Anjali Duggal, who was very supportive. And I have to say, RBI, Viral Acharya was also very supportive of the line of thought. I had many disagreements with him on monetary policy, but on this issue, we were on the same side. So there was then a group of people who were ready. So we decided to attack this dirty dozen of 12 companies with the biggest defaulters. They were defaulted, they were sold off. We got decent recoveries from it. But most importantly, what happened is that credit culture in the country suddenly changed. So all the rest of the 38 who we hadn't even acted against, many of those chaps came and gave back the money. And then many other people came and gave back the money, and suddenly the banks had lots of capital coming back. And we didn't do it a moment too soon. Because as you know, by beginning of 2020, we went into the COVID crisis. So let me tell you, if we had gone into the COVID crisis with the banking system we had in the beginning of 2017, then, we would have had like that Sri Lanka massive crisis that they had. We would have had something like this. We didn't do it a moment too soon, but with the effort of all these people, RBI, IBBI, Finance Ministry coordinated, and of course the NCLT has to be given. So we got this, and Insolvency and Bankruptcy Code, in my view, is been an absolutely brilliant reform. There are many problems with it that remains. There have been a recent attempts by our Honorable Supreme Court to trip it up in various ways. But let me say that has been a great success. And for all its flaws, it has changed the way in which creative destruction happens in India and changed the credit culture. So I would say that if we are today sitting here and being reasonably happy about the financial stability of the system, I would put IBC as being right up there, along with, by the way, something Ashima ji has been a part of, which is the Monetary Policy Committee as well.
Thank you, Dr. Sanal. That's a phenomenal insight. I think that phenomenal insight one would not have seen or heard anywhere else. Now, I'll just change the order a bit because there is a related question. So my next question is directed to Dr. Mishra. So mic is still working, so we can continue. So, we talked about financial stability. We talked about supervisory approach, changing from, annual audits to move to a culture where questions or, stock taking is done around the year at the supervisory level. And that is linked to what Dr. Mishra earlier referred to, smelling distress in advance, which he attributed to the previous governor, Dr. Professor Das. And so stability, resilience, smelling in distress in advance, how are these, if you can explain us the difference between stability and resilience in this context, what you earlier spoke, I'm just catching on to that.
Because as you said, and he told, we have become too stable. What next? And I wish to tell you, Academic Council has already approved a new course I'm offering, which will be first time in the country, is New Age Financial System Towards Resilience. So,
you have to speak on the mic.
So maybe we'll again call you to launch that in January.
Okay.
So that new course, it is already approved. What is that? Once you become too stable, what next? So that means stability and resilience are not synonymous. They're different. What is stability? Stability is not defined in the literature. Instability has been defined. So lack of instability is called stability. So that means we have to first define what is instability. So instability is the departure either way from a historical average in a particular financial sector indicator. For example, NPA. Suppose we find NPA is a good indicator and historical number should be 3%. So any hike, suppose beyond 7-8% is a point of instability. Okay, same in inflation. We have threshold 4, 2, and 6. So beyond 6, point of instability. So that is stability. And what is resilience? A sustained state of stability is resilience. That means when a point of instability is fixed, so the outcome would be that point of instability will never occur. Plus, I will fix it in such a manner, not only that point of instability will not recur, any associated possible lurking risks also will not appear. That is called a state of resilience. Like in growth case, if we have 8% growth rate for 10 years, so then resilience in economic growth, it can be told like that. So what does it mean? So that means, I will give an example that will be best example, which I have given in the book. That is, suppose there are two ways it can be done. So we have a crisis management framework, means carbon dioxide everywhere, in every floor, everywhere. Last 100 years you are doing, investing on it. Never fire has cut and lot of money is spent. So that is one way of investing money on stability, possible stability of a building. Similarly, suppose with newer modern techniques and tools, we are able to produce fire resistant materials to produce a building. So then, so our allocation for crisis management will be minuscule, while initial investment will be more. But at least next 100 years, you are sure it will not catch fire. That is the difference between stability and resilience. And another clarification. So with financial stability report in India, we have redefined macro financial system. That is again we are the first. Now we used to write like that. If you see the chapters, financial system is categorized into 3 segments: financial institutions, financial markets, financial infrastructure, and the addition from Indian side is economy. Why? Because all these 4 are so hugely interconnected. So if you ignore one, then you will do injustice to solve the whole problem. So, and this was again a lesson from the global financial crisis. A small institution called problem started. It engulfed the whole world. So interconnectedness has been discovered. Cyclization of booms and busts, which that crisis thing you told, means earlier once a century crisis was happening. Then it became decade. Now you don't know anytime anything can happen, like Trump and he told. So these 2, and third one, interconnectedness among risks themselves. Like for example, suppose you want to measure credit risk. Market risk also has an influence on credit risk. If interest rates rise, credit risk will rise in the banks. So it has become very intricate and difficult to measure even risks themselves. So interconnectedness, solving of problems of interconnectedness among sectors, among risks, and finding a solution in advance where a bubble is going to start, so that you don't have to wait to prick it and create havoc in the economy. So these are the 3 things. Is called, we are going towards resilience. No one has gone in the world like that, but we are the pioneer to teach to the world. And why I am saying, with what audacity I am saying we are teaching it, that also I will tell. So Federal Reserve, Bank of England, Germany, France, they used to come to College of Supervisors to learn this. Gone are those days when they were not giving us a nomination for their training programs. Now paying for themselves. We only give them hotel fare, hotel and local transport. They come all the way to India. So that means, so we are the mother of the concept of resilience. we are the mother of the concept of pre-mortem supervision, and that is why it feels we are over. But once you feel you are overstable, start working towards resilience, and which we have already started. So that means next issue and onwards, we should start writing on resilience, not stability. Stability issue is addressed; it is gone.
Thank you. Thank you, Dr. Mishra. My next question is for Dr. Goyel. The FSR observes that notes that the capacity utilization in the country is high. There is an uptick in investment, and all of it seems to be driven largely by government thrust on capex, infrastructure, and government ultimately funds much of it through raising fresh debt, and therefore interest as a component of the government revenue becomes an important factor. In fact, I recall way back in the NDA one, every year before the budget, they would call the captains of industry. We're talking about late 90s, 99, 2000. And one of the such captains of industry I used to work for in those days as an analyst. And the research that we produced was that the interest rates on a real basis, that is after adjusting for inflation, was high. And this high real interest rate itself was making the government expenditure high, leaving little for infrastructure. And that is one of the points that year it was taken in the agenda. So my question is that to you, Dr. Goyel, is that would you see risks to investment and consumption should the government's role in its expenditure come down in any significant way? Do you think private sector can step in?
Yeah, I think, meetings like this are very important because there's a certain way of thinking that gets entrenched, and everywhere you hear the same thing. So, this view that the private sector is not investing, it's only the government. First of all, our gross domestic capital formation to GDP ratio is above 30%, which is very high compared to most countries. And out of this, at least 80%, more than 80%, comes from the private sector. Household, physical savings, corporate sector, government is only 7%. Yeah. So it cannot be that the government is driving investment. But it is true that corporate investment especially has softened over the last year, fallen 2%, had recovered after the pandemic, while government has increased from about 4% from about 2% of the budget, the central government, to 4%. And so, in a sense, they are increasing while the corporates are not increasing as much. But this issue of the interest rate, that is linked to the resources available to the economy. So here the idea is that we are not saving enough, or household savings are going down, and that is a possible problem. But households are actually, their gross financial savings are rising. They're allocating more to equity and so on, so that it can be allocated better for investment. So that is not an issue. But government, the rate of interest that they pay in India is very, very high. It used to be 8% for a 10-year G-Secs in the middle of last decade, and now it's down to 6.3. So this is related to the financial stability issue because there is more financial stability, less volatility, and better allocation of resources. The level of interest rate comes down, and here inflation also, because inflation has come down. So the level of interest rate come down, but also the spreads. So the 10-year G-Sec compared to the repo, that spread is coming down. That means the government has to pay less. But even today, about, I think, almost 40%, 37% of government revenue goes in interest payments.
Right.
Or if you take it in terms of GDP, then say the central government is spending 4% of its revenue on capital expenditure, but 3.6% on interest payments on past debt. So that is an issue. So, but I think that in India we have such vast infrastructure needs. State governments also have to spend, and they're beginning to spend in many ways. So it's not going to be that we're going to run out of opportunities for the government to invest and for government investment to rise. And as interest rate spreads shrink, the interest rate level comes down. The government has been very conservative in terms of, we are one of the very few countries where deficits are actually coming down. You see US or China, their deficits are rising, their debt is, while for us, it rose to a peak in pandemic times, but then also they were very careful in the sense that not blanket checks or transfers, so there was a lot of pressure for that kind of expenditure. But given our population, if we started writing checks to everybody, we would have deficits of 30% today. Not consolidated deficit is 7%, but this is still high. But because it's coming down, interest rates are coming down, levels, spreads, inflation, that is macro stability. So the cost of borrowing comes down. As you grow, more projects, more areas become developed. So the demand or places where you can invest rise. And at the same time, what is very, very important is smoothing the macroeconomic part. We've had in a growing economy or a transition or developing economy, you can have very high growth. But then you have volatility, these shocks that lead to an absolute fall in growth. Yeah. So because of that, you're not over on an average doing well. China grew at 10% for extended number of years.
Yes.
We've not been able to do that. But this smoothing, macro stability means that growth is going to be more stable going forward. So last year, again, there was monetary, fiscal, regulatory tightening. It was election year, government stopped spending. So you saw growth fell from 9 to 6%. But now I think this lesson should come in. After the pandemic, we showed that with counter-cyclical and policy, you could smooth shocks, you could grow at high rates and bring inflation down. So we can hopefully do that in the future also, which will sustain investment and reduce the kind of risks you've been talking about. Yeah?
Right. Thank you very much. Actually, you preempted my second question about the sustainability of government debt, but you have already answered that. My next question is for Mr. Nair. So on the FDI side, we have had strong, FDI on the external sector, and we have more or less met the current account deficit with our capital flows, more or less. So just about balance. So what do you think are our strengths and weaknesses in the current structure of balance of payment? Because on one hand, we have a high current account deficit or significant, and then we have good amount of what shall I say, capital flows as well, increasing on the FDI side. And so maybe you can share your thoughts with the audience.
So I guess when we analyze on the financial system or the FSR, we look at the balance sheets. We look at balance sheets of households. We look at balance sheets of government. We look at the balance sheet of the external sector. I think if you go back, the two major crises for India, whether it is the 1991 or the 2013 taper tantrum, you look at both of those times, the external sector was really bad at that point in time. In fact, the highest ever current account deficit was in 2013, 4.8% of GDP. Currently, it is around 1% of GDP, so current account is eminently manageable, extremely good. At times, we celebrate when the current account goes into surplus. In my opinion, that's not a good thing. For a growing economy, to have a current account surplus is not a good thing. The other important thing about the current account deficit is current account deficit or the external balance is a reflection of the internal balance. So it's a sum of the public sector balance as well as the private sector. So when your external sector is doing well, it is also reflects that your internal, the economy is doing really well, right? We have a problem on the FDI, not so much on the gross FDI, but on the net FDI. The gross FDI has been pretty strong, but what's happening is quite a lot of the flows are going out. And now you can look at it two ways. Okay, one is, okay, it's a good thing because there's a lot of private credit and other entities have come to India. They invested in good startups, and now after a 5-year lock-in period, they are taking the money out. That's fine in a way to look at it. But we are also in a world where the financial flows have become extremely concentrated. I mean, world is moving from a multipolar world to kind of a bilateral arrangements and things like that. So if your ideologies don't meet, sometimes the flows doesn't come, right? So we don't have much of a problem on the current account deficit in the sense that it is around 1% of GDP. It is eminently manageable. But I think what we need is sustained high levels of capital, which is the foreign direct investment. The foreign portfolio investment has been negative this time, but that's okay because quite a lot of that is being counteracted by the domestic investors. In fact, for the first time in a long time, the domestic institutional investors or the domestic investors actually have more share in the stock market as compared to the foreign institutional investors. So current account deficit per se is not an issue, but I think on the capital side, we need to be continued to be judicious in terms of attracting long-term foreign direct investment, and that will work with probably I've heard this on separate issues on Sri Sanyal talking about how do we improve the ease of doing business. I mean, structural reforms which makes it much easier. I think one of the things correct me if I'm wrong, sir. I remember you telling that I think in India, if you want to start a hotel business, you need about 50 license. But if you want to have a gun, I think probably you can have about 20 or something. I remember you telling that, right?
26 versus 19.
Yeah, so 26 is the requirement to get a gun vis-a-vis the other way around. Okay, fine, okay.
Restaurant requires 26 approvals in Delhi.
In Delhi, okay. So
Or Mumbai, I forget one of those.
yeah.
And 19 for the gun.
Yeah, 19 for the gun, right? So those are the kind of things that really we need to focus on, because we for a long time we have, as Professor Ashima Goyel also mentioned, we have a really stable system across any parameter that you take. Whether it is the economy, whether it is the financial system, whether it is the external sector, and then the only bit that I'm really still have some issues is on the household sector. We can talk about that, but everything is really aligning for us to do well. And I think the thrust should be on the reforms so that the foreign direct investment grows, because that will take care of the capital flow issues as well.
Thank you. If I may ask a follow-up question. On the external sector, internationally, the NBFIs, especially in the US, they have been receiving a lot of financing, instead of banks. So if you see the American capital flows, a lot more is going internationally into the NBFIs than the banks, and the bank themselves are lending wholeheartedly to NBFIs. And one of the reasons for that is that banks have not been touching lower rated corporates there, and that kind of lending is happening by these NBFIs, because it's simply banks are saving up. So the central bank asks them that if you're lending to lower rated corporate, then you put so much in capital. But if you're lending to a non-banking financial institution, less capital. So lending is happening through NBFIs, and that's why capital saving is there. Now they call it the new shadow banking crisis, and they are also investing not just in corporate, they are also investing in retail assets through pooled assets like ABS, MBS, and if I'm not mistaken, more than $1 trillion and about $1.5 trillion of amounts are outstanding, 1.2 trillion. And US Treasury purchases are at the same time coming down from international buyers. Now, this seems like a delicate equilibrium at the moment. Any kind of disturbance here you think is something that we should see as an area of to be cautious about, either you. So whether Dr. Sachs.
So globally, I think the non-bank financial intermediaries have taken over the financial system in the sense that they are much more than the regulated banking system. It's about 50% NBFIs and about 35% is the banking system. In India, it is still 56-44 in terms of the banking system. So that's the trend. That's also a fallout of what happened after the financial crisis. So-called Basel III regulatory regime came about. The regulations were made quite stringent for the banks. So naturally, money will flow to the least regulated area. And the NBFIs have become really large. They continue to remain not well regulated or lightly regulated. So there is a lot of transparency and opacity related to NBFIs, which could be a problem. So what we see increasingly across markets is that what's happening is market is being taken over by what you call as price sensitive investors as opposed to price insensitive. So for example, banks have long-term view, so they normally keep their they can act as market makers, they can act as buyer and seller. The non-bank financial intermediaries are there to make money, right? So for example, if you look at what's happened with the Jane Street, it essentially you are trying to arbitrage a small gap between the cash and the derivative segment. Similarly, the NBFIs try to take advantage of these things. And when they take advantage, generally what happens is it creates ripples in the cash market. And cash market is where the banking system is involved, the underlying market. So it creates a problem in the underlying market, and then the regulator has to intervene. And this is what happened in 2022 in UK with the pension fund crisis. Again, so the trigger for all these crises is now coming from the NBFIs. And then it lends into problem for the banking system, and the regulator has to act. So we need better regulation for NBFIs, but that's a challenge.
Dr. Sanal, if you could.
Yeah, I think for the benefit of the students, I think I need to give them a little bit of background to why this debate happens at all. You see, you have to understand what on earth it is that financial systems do. Financial systems are really the mechanism that an economy has to allow for risk taking. So every economy makes progress because entrepreneurs take on capital, they take risk. Obviously, the very fact that it is risky and entrepreneurship is risky means that some part of it goes wrong. Now, if you have a financial system, a banking system that takes too much risk, you'll get a boom for a while. But if you have gone and misallocated it, as happened with our own economy at one point, and as I mentioned earlier, you will then have a crisis. So to stop this from happening, regulators and supervisors then clamp down on the banking system. Now here comes a risk, which I said, this too stable problem. What may happen now that the opportunities of making money still exist and they continue to be risky. Just because you put more regulations on banks doesn't mean that money making is become a safer activity. It's not. There are still many opportunities, and some part of it is healthy. But what happens is this risk taking, because you have got so many regulations on the bank, now goes away from the banks and ends up in other parts of the system. Let's call it the shadow banks, non-banks, whatever you may want to call. Now, this is also to some extent a good thing, and in fact, the equity market exists to allow this to happen. But very often, because equity markets too are regulated, some of this dribbles off to the nooks and corners of the financial system into this shadow universe where it is avoiding the regulations. Now, here, if the regulators say, no, we shouldn't allow any of this to happen, this is may actually be harmful in the sense that these nooks and corners are where some of the most interesting innovations happen. So on one side, you don't want to choke it off. On the other hand, it is outside the control. So sometimes, as is now happening in the US, this thing that you allowed to happen, because that's where the innovation is happening, that has now gone off kilter and become too big. So you have a nice, well-regulated banking system, which is not doing anything, but it's regulated. And you have a non-banking thing, which actually is doing the interesting stuff of risk-taking, but is not regulated. So this is the problem of an excessive, this point about, is it too stable? In a system that is too stable or a very heavily regulated banking system, you will see the NPA levels keep dropping. at the limit it'll go down to zero. But is that a healthy thing? No. It could mean one of two things. One, that this economy is just not taking any risks, which is a bad thing. Or it means that the risk takers are happily gone off to some other part of the economy and they're taking risk there. So you are sitting here with a well-regulated banking system, which actually doesn't matter because the risk has gone off somewhere else in the system. And meanwhile, the lights have gone out of our lives.
Thank you. Thank you very much for that. So I'll come back to Dr. Mishra a couple of questions later. Related question is that, so my question would be that why, whether scale-based regulation is something related to this. But before that, I want to ask another question for Dr. Sanal. That, we have had the FSR notes that we have had phenomenal amount of resources being raised from the capital markets, 1.57 lakh crores. And debt is about 65% of that. And if one were to look deeper, one finds that most of this debt has been subscribed, that have been subscribed belong to issuers or those who are borrowers in the debt market by issuances are, top-rated entities. It has not trickled down to lower-rated entities. So there could be two ways to look at it. One, they are not benefiting from it, and they should. Two, is there a financial stability angle to it?
Yes, I mean, so this relates to the point I was making earlier. If you think about it at only the superficial level, you'll all be very happy. See, only the triple rated are taking money. But in fact, as I said, when you're going into the capital markets, this is all about risk taking. If only the AAA is raising money, the fellow just below him in AA, single A, or even Bs are not raising money. It basically means that those in the system who could potentially take risk are not being given money, and only the safe players are giving money, or very big guys are being given money. So you will have capital basically either rising up and to a few handful of, so it'll be an excessive concentration, which is also bad for risk taking because it means new blood is not entering the system. And simultaneously, you also means that there are smaller entities who may be doing interesting things. After all, company like Amazon didn't make money for some 20 odd years. If you went by the conventional thinking, it shouldn't have existed. It made losses for, I think, 20 years, some very long period of time.
That's true.
And if you went with our way of thinking of our system, we would have never given it a AAA rating. But to be fair to the American system, it was willing to keep such a company going for long periods of time. And this is why equity markets do matter. In India, for example, a company that has only ever made losses would not very easily be allowed to even list.
That's true.
Okay. Now that's a bad thing because it means that we are never able consequently to create companies like Apple. So this is why this whole thing is related to risk taking. When there is too much stability, either the risk will escape into areas you don't control, or you are not giving the risk takers money. So the fact that all this money is being raised only by the AAA guys is, in my view, not necessarily a healthy thing.
Thank you. Thank you. Yes. Dr. Goyel, please.
Just to have a little bit of that discussion. I mean, I think there's such a thing as balance and also different types of instruments for Apple or firms, equity. We have our venture capitalists and we have that universe which encourages risk taking. But I think one of the big successes in reform that we had was much better underwriting in banks. The banks lend to projects without evaluating just because somebody rang up and told them to, after the GFC, which led to the crisis. So you want to do a careful risk-based assessment, and you're also giving them independence to price it so they can price at different rates. So sometimes they say you can't have NPAs actually because if you're pricing risk appropriately, you already recovered. whatever you gave, many times you recovered many times over, and it's just the accumulated debt which is there. And also, there is an advantage in the Indian case where we have broad-based regulation. We are willing to regulate the entirety. In the US, they only regulate borrowers, banks, for example. So it's all on the, and therefore Janet Yellen has gone on record saying that we trying to, because of huge financial market lobby. And so obviously now, if you are after Basel III, after the GFC, when banks were implicated, all the Basel, the recommendations, the regulations were for banks. And as a result, there's obviously arbitrage, to shadow banks, to hedge funds. And those are the sources of cross-border flows that create volatility for us today. Well, we have a much more balanced, you can ask Ayapan, that our regulations, there's scale-based regulation for NBFCs also. We have prudential regulation, we have margin requirements and so on, which is very often not there in advanced. Sorry.
Thank you. In fact, my next question is for you. It's for you. And it's an interesting question. So I've been, one has been seeing in the FSR that talks about household debt has been rising in recent years. Now, whether you can break it down, if you would like to break it down for our audience and for me, whether is it because of some kind of distress going up, or is it because of the formal lending, that is financial inclusion becoming better at lending? Because a lot of it is loan against property, personal loans, which you would not have earlier got so easily. So.
Yeah, so I think as the informal sector gets formalized, we always had those chitty funds and informal borrowing. Some of that is coming into the formal sector. So perhaps measured debt is going up. Well, the actual debt we don't know because the informal sector part is shrinking. And as I said, there are a lot of MFIs there who have venture capital funded, and they're really pricing, and they are profitable, so they're not loss making, they're covering their risk, and a lot of innovations in this space. But also when we say household debt is rising, we should be a little careful, because BIS, for example, measures this. And how Indian household debt had gone up to 40 during the pandemic. But after that, it's been coming down. It's about 36 now. But just as a benchmark, in emerging markets, it tends to be 50. While in advanced economies, US and so on, is 75% of GDP. So we are borrowing much less than consumers outside. And if we want a consumption-led growth, and investment is induced by higher household consumption, then we want banks to lend more, then these debt levels have to go up. But they have to go up slowly, steadily, without creating. So I think when the RBI tightened regulatory weight on credit card lending, because that was growing at 30%. And as economists, we know anything grows at 30, it's going to be poor quality. And so that has come down after that. So you can tighten in certain sectors. And I think one very, very important, I don't know, Sanjeev, if the government is thinking about this, because IBC was a huge success because it improved incentives. People could really recover, banks could really recover what they had lent earlier. This never used to happen. But the IBC, the personal bankruptcy has not been notified in that. And we still have colonial time rules. So that means a very extensive legal process and no protection of your living standards. So we are discouraging risk-taking at the individual level. I know many horror stories of, my own secretary, her son for his marriage took some loan and 4 or 5 banks, credit cards, and they push credit cards at you, and then they follow, and they had to sell their house to pay this off. Now, this sort of thing, we need to protect people from that.
Yes, thank you very much.
This is a major issue actually about personal bankruptcy. Matter that, by the way, there's a lawyer called Sumant Batra who's been really pushing for this. So it is an issue. I also feel that we really need to have the proper IBC for individuals.
Can I just add a couple of things on
Yes,
the
please.
household debt? So,
Yeah.
So one of the things that is happening with the household debt is that generally debt fuel consumption at some point in time creates a problem for the system. So there is a lot of unsecured loans which has been building up, which is a problem. So now, for example, the point that because you don't have a personal bankruptcy or anything, banks are writing off. So it won't reflect in their non-performing assets. So you look at the non-performing assets, banks just looks at very clean balance sheet. NPAs from your unsecured loan is 1.5%. But then you go beneath the numbers and you will find that a loan which is sanctioned at the beginning of the year, in 6 months you are returning it off. Okay, and partly because bank can do it is because also an accounting way, because you follow an account accrual based way of accounting. So 6 months you accrue the income. After 6 months, you think that, oh, you cannot recover it. I just write it off, right? So these are not essentially good things for the system. I mean, you want debt to happen because the formalization is a good thing. But these are some of the issues that we are finding it. One other issue that we continue to have a problem in India, I think that probably that hopefully will get solved with the new committee that the government has formed under Mr. Sujit Bala, which is on the household income survey. We don't have good data on household income survey. We have a lot of information on the liability side of household because banks and NBFCs we regulate, we have information. But on the asset side, we don't have too much of information. One last point is there is a lot of money also. We are worried that money is being taken from the system and diverted into equity markets. And for example, these called real money gambling, which are like when the IPL happens, Dream 11, Pokerbazi, and those kind of things, right? There's enormous amount of money. And what then that does is, especially for the younger generation, they think that this is an easy way of making money. And then they get hooked into it, right? And then a problem comes, it's not only a financial problem, it becomes a social problem. So that's another bit that we are trying to figure out whether, because money being so fungible, it's very difficult to target, okay. So for example, in a household, a father might take a loan in the name of a daughter, but invest in the name of the son. So it's very difficult to say that who is actually taking, who is investing. So that's another bit that we need to be concerned about. Household debt at an aggregate level, like Madam said, is pretty low compared to other economies. But these are some bits of things that we need to be mindful of.
Right. Thank you. Yeah. So
Before you ask me my question,
yes. So
let me link 2-3 points.
Okay. Please.
First, there is a very interesting empirical verification of the famous Minsky's theory. Stability breeds instability. With a sustained state of stability, that will be a precursor to instability. That is another lesson from the global financial crisis. Exactly in our health thing. So if you feel yourself health-wise honky-dory, that is the time you should start annual health checkup. Something else might happen. That is about that. And that is now being tried to be one of the early warning indicators for macro financial system, which RBI chair is going to do research on this year. So we are working on that. That is one. And second, about you, why this is happening? These unsecured, there are two arguments. Because if you don't give unsecured like personal loans, there is a problem. Because demand for big credits are low. And so if you force on, you cannot go beyond a limit for personal loans or unsecured loans, then banks are losing. But the other side is, if they do, the chance of they getting contaminated and then NPA is more, so it is a short-term versus a long-term issue. But why it is happening really is, we are not doing the way risk management should be done by the banks. So this is what are the new questions we are asking in the banks since last year. What is that? So risk management, historically in your books, is identifying, assessing, measuring, and managing. So you ask any chief risk officer, I have asked, do you know how to measure reputation risk? No. Then how are you managing the risk? So without knowing how to measure, we have been claiming that we are managing risk for all the time, last 100 years. So under the false complacence that we have been able to manage risks, so that risk reward equation has evolved. So now everything has fallen into ground. How it should have been done for the benefit of the youngsters. So first, whenever there is a risk-taking ability is an institution-specific issue, like eating. I may be able to take 3 chapatis, he may be 10. So how can you give the same prescription? same medicine for both of us. Correct? Similarly, the risk SBI can take, RBL cannot take. Or and again, it depends on the portfolio you are owning. Suppose a bank which doesn't have real estate portfolio much, so they need not bother about certain kind of things. So what they have not done, which RBI finally had to increase risk weight and all to control, to use macroprudential for unsecured loan, is that risk appetite and tolerance, which is a part of risk management system, which is risk appetite framework, is not being done properly. Risk is dynamic. Yes or no? Risk cannot be static. If risk is dynamic, the capital to cushion risk has to be dynamic. But in India, our risk appetite system is published once a year. Our capital ICAP is done once a year. So this should be on ongoing basis. So that is where the malady has risen. That is why RBI was worried. The unsecured loan advance is going more, so we are worried across the sector. But question is, if unsecured loan at 90% of a bank would be reasonable, why you bother? Provided they have made their risk appetite, tolerance and management system perfect. So issue rise there, not having secured or unsecured loan more. That is where role of supervision comes. And that is where, again, I am called a die-hard Indian nationalist. That is where Indian supervisory system has taken a prime of place in the literature of supervision.
Thank you. Before we proceed with the last round of questions, I would like to invite the audience to ask a few questions in the interim, if you have any questions. Yes, please. Is there a mic?
Can a mic be
Mike.
Take this.
Hello.
You may direct it to any individual panelist or in general.
Sir, my question is to Honorable Chancellor, sir. Given the current international business environment and the uncertainty, especially the kind of surgical strikes Mr. Trump has done on Indian economy, how should we ensure the international stability in the overall business environment?
So first of all, it's not really a strategical strike. You have to understand that as we rise as a global power, we will have to get used to the fact that even our friends will be uncomfortable with our rise. And so we should get used to the fact that there will be some pushback. I can assure you, it's not because he particularly dislikes us. In fact, he has himself said that he considers India the friend. But you see, we have to get used to the idea that even those who are generally positively inclined towards us may not particularly wish us well if we become a global power, because we are ultimately taking up space that belong to somebody else. That does not mean that we in any way should stop pursuing our own interests. As we become bigger, we will get pushback, but we also will have resources to do and pursue our own thing. And we should continue to do that. There will be occasionals where we will have to make trade-offs. We'll see how our trade negotiators negotiate. We may have to change stance here and there. But generally speaking, we should keep going. Because this is the only, in this world, let us be very clear, India punches way below its weight. And if we are thinking that we are now in the next 24 months become the world's third largest economy, at some level we have to learn to behave like one and consequently also take the punches when they come along. Every time some punch is thrown at us, we can't get thrown off.
Yes, sir.
There's a gentleman there that you may want to.
Good evening, sir. So my question is, despite our stability, why are we still lagging behind countries in Southeast Asia when it comes to attracting businesses that are exiting China right now?
That's okay. See, first of all, it's not entirely clear that they are going to exiting China and going to Southeast Asia. Some of them, like Apple, for example, is clearly coming to India. Our problem, interestingly, is not actually gross FDI. Our problem, as Professor Nair just said, it is actually in net FDI. Lot of Indian companies are actually investing out, or they are using the high valuations they are getting in Indian financial markets, like to list themselves and take some money. Hyundai is a good example where. So this is an issue. Now, should we stop this? No. In some ways, this is good because it is a good advertisement that India allows you to make money and take it, which is quite in contrast with what happens to China, by the way. China, lots of money goes in, but nothing comes out. So in a sense, this is good. Our real game should be to not get distracted either by Mr. Trump or by, people may want to go to Vietnam or whatever they want. Our game is to up our own game. We need to be more competitive. This requires that we look into ease of doing business. We up our game on process reforms. We up our game on infrastructure. We up our game even on signing free trade agreements with the US too, by the way. But we are now in advanced talks with the European Union, as you may be aware. So maybe that will happen faster. Maybe even the US one will happen. Because look, posturing before negotiations is a standard tactic. Everybody does it, by the way. President Trump may do it in a way that you may find a little disconcerting. But let's be very clear. He postures with everybody. He's done this, by the way, with every country he has signed a treaty. And so we will too have to take it. And, as I said, if you want to play in the global game, you have to be willing to take a few punches. So I think we are in a decent place, but we have to up our game too, because the rest of the world is also improving their game. And this is going to all happen in an environment where some amazing technologies are appending many things. For example, artificial intelligence, but that's a commonly talked about one. There are many other ones happening in genetics, it's happening in space technology, it's happening in communications, defense, all of these areas where we are a player in many of these things. But can we say that we are doing as well as we could have? Perhaps not. In fact, I keep saying that this is an area, very often much of the criticism correctly comes to the British, to the government, but actually the private sector of India also now needs to up its game. When I go to these one of my jobs is to go and talk to CII or FICCI and these kinds of events. And typically, the discussion eventually gets to R&D, and I question Indian industry. Why is it that you guys don't invest in R&D? Because what is happening is that in India's private sector has one of the lowest research and development budgets of any large companies in the world. You'll be shocked by companies which are running tens of thousands of crores of profits, and their research and development budget will be, 200 crores or some tiny ridiculous number. And so here we have to understand that maybe we need to look at our private sector as well. Are we protecting them too much? Are we allowing enough creative destruction to happen there? Because in the end, one major driver of risk-taking, innovation, research and development is paranoia. And if you protect ourselves too much, you will actually end up not having any of this. Instead, what you will get is family offices in Dubai and discussions on CSR projects. And you'll hear people coming and say, we also make steel. But why do you also make steel? You should be making steel. That's your job. You're not an NGO which guiltily makes steel. Right? So this is something our private sector too has to get out if we want to really compete. Where is our Zuckerberg? Where is our Elon Musk? Where is our Bill Gates?
Thank you. Very insightful. maybe we have time for only one question now, and then I'll go back to the panel for a last round of questions, and then I'll come back.
Good afternoon, panel. My name is Nupur. So, as we talked a lot about financial stability and steps to move from stable market to a resilience way of financial stability, hence, given that this new financial ecosystem that we are seeing where corporate bond markets are there, NBFIs that were a major discussion of the panel, is it contributing to that process where we will be moving from stability to resilience, or in a long term it can be a hurdle because households are vulnerable? We are not seeing parallel level of investment in growth. So that is my question, that is it a contribution to the factor of us moving from a stable financial market to a resilience, or it can be a hurdle in a long term market?
I don't think it is a hurdle. I think it's a journey. You need stability before you move into a resilient financial system. And I think what the thing that we need to, I think probably it's an Indian mentality to be too conservative on everything. I think that's what probably sometimes holds us back. We need markets to develop. So if you look at the corporate bond market, that market is essentially a AAA only market. 95% of it is private placements. These are not good. So for example, if you are a medium and small enterprise, which obviously has about 50% of employment that provides, they are not in a position to go to the market and raise debt, right? So you want equity market, you want debt market and those kind of markets to develop, because that is the place where long-term risk capital is generated. I think quite often what happens in India is that for every problem related to financial system, we try to find a solution through the banking system. And I think that is one of the things that we need to be worried about, because banks, if you look at their business model, they are inherently designed to fail. Okay. The simple logic is because your liability is deposits, which any one of us can walk in and take it. Your assets are long-term illiquid assets. So you need to ask yourself the question, do you want the banks to fund infrastructure projects, right? Rather, it will be the debt markets that makes more sense to do those things. So as we have more market development, I think that will lead to more long-term capital formation, and that will be beneficial for the economy. And by diversifying all those things, you are making the system more resilient, because you are not concentrating on one bit, right? You're ensuring that the capital is moving around the system, and that leads to a better financial system, more efficient financial system.
Thank you, sir.
Let me move to the next round, and my first question is for Dr. Goyel. This is regarding the exchange rate, dollar rupee exchange rate.
Right.
And so our real effective exchange rate, and you will also have to explain them what real effective exchange rate is. Now it has been stable for the last several years, which it wasn't. Earlier it was moving a lot, and last I think 6-7 years it has been stable, and the high real effective exchange rate, our exchange rate being overvalued, was one of the vulnerabilities pointed out even by Professor Paul Krugman when he visited India, saying that your exchange rate is overvalued and that is maybe hurting your competitiveness. And now that we are stable at a competitive rate or stable?
Yeah, just before I come to that question, let me just give one example for the last question, which Ayapan answered very nicely, but just an example which might clarify for a student. It's like we've done so well in India by outsourcing, not only technology, but even same cleanliness. Colleges, bathrooms used to be, once you have outsourcing, you have a contractor who is doing it. So it's about comparative advantage, specialization. Adam Smith's example of a pin. No, so similarly in the financial sector, we have different people taking different kinds of risks, different kinds of entities coming in. And banks' role will shrink, but because the whole economy is growing, that role will remain really large and important. And one of the strengths of our financial sector currently, reason for stability, is that we are diversifying, but in a balanced way. Banks are not disappearing as they are in the West or becoming a shadow of markets. Yeah. So we are doing, and suppose you had everything collapsing around you, inflation at 40%, and your savings disappearing, you think the economy would do better? Ask yourself that. Yeah. So I think we need some stability. Now about the exchange rate, sorry. This real effective exchange rate is looking at the exchange rate of our trading partners or export partners, looking at their relative inflation. So if our inflation is higher, then our currency will depreciate. And that is the major reason why we've had continuous depreciation of the nominal rupee, because our inflation is higher than the rest of the world. But now it's coming down, it's 2% currently, and US is 3%. So in the future, you might see less of this. But there are many other factors that affect your comparative advantage or your productivity growth. And we did some work on this where we found two factors, structural determinants in an emerging market of the real exchange rate. The beer theory is called beer or fear. There are very many varieties, fundamental, behavioral, so on. But we found two factors really important. One is a relative productivity differential. Is the Indian economy becoming more productive than the US? Yeah. And the relative growth of the financial sector. And these worked in opposite directions. So to answer your question, that means that the real exchange rate index 2014-15, about 100, that is still a competitive level for us. And we've seen not only the theoretical side, but even in terms of how exports are doing. If the real effective exchange rate is around 100, things are going well. Our current account deficit currently is really low, etc. Yeah. So for Paul Krugman, he visited India in 2018, and that time over 2014-18, as a response to the global financial crisis, we had real appreciation. Exports also suffered, but in the latter half of 2018, it had fallen back to 100. As you're saying, it was about that level. And on average, though there have been fluctuations, it has stayed around that level. And that is an okay level for us from the trade point of view. We are competitive at that level. Yeah. But I think the RBI has a policy to intervene if there's excess volatility of the nominal exchange rate, and our large reserves really help with that. But it might be good. Most central banks in emerging markets do not want persistent misalignment of the real exchange rate. And that can happen with emerging markets where there are fear and self-fulfilling prophecies and too much volatility. So, and we've been able to avoid that with our reserves and our exchange rate policy. We need to continue doing that. Maybe we should have a formal thing that no persistent misalignment, real misalignment.
Thank you. Very insightful. My next question is for Dr. Sanal. The crux of the FSR, the second half of the FSR is about the stress testing the banking system. And the stress test of the banking system has been done at a high, some severe level, and it shows about a couple of percentage points dropping from the capital of banks, which are right now at 15-16%. So how do you see the banking system's resilience from these stress test results?
Okay, so this is a highly technical question, so I'll try and ease it as much as possible. So you see, just in case so the audience doesn't know, there are all these capital requirements that that banks have, because essentially, as Dr. Nayer said, banks are ultimately a Ponzi scheme. Okay, so in order to make sure the Ponzi scheme doesn't blow up on you, they are made to hold certain amounts of capital in various so-called safe assets, so that including cash, so that there is enough buffer to keep that Ponzi scheme going. Yeah, that's basically banking. In fact, all of finance is at some level based on this idea. So it's not necessarily a bad thing. It's just that this has to be managed, and therefore the Reserve Bank of India and other countries, their central banks, essentially insist on a certain amount of buffer to keep this banking system running. Now, the point he's making is that since Basel III norms and all these other norms were introduced, and we have cleaned up the banks, If you go with these formal capital requirements, India rather looks very good, and I would argue it looks, surprisingly good, given that we went through, harrowing COVID crisis, all kinds of bad things happened, and we look rather good. So I would argue, yes, that is true. However, the nature of risk and uncertainty is that there is always some random thing that can come and hit you from an angle that you did not imagine. And in this context, let me say, obviously, the very fact that I don't know what they are means how do I prepare for some shock like this? So, first of all, even after we have done all of this, we have to allow for the fact that there has to be a active supervision. So that's why the difference between regulation and supervision is very important, because regulation is a set of rules and you follow these rules. Supervision is a more active activity in that you have to keep your eyes and ears open for all kinds of random things they may happen which may not be formally written down. Yeah. Now, this is why supervision is very important. Historically, supervision and regulation were seen as basically the same thing. And this is one of the innovations, by the way, that Professor Mishra, when he was in Reserve Bank, had done, is to create a school of supervision, because this has now got to be a much more active activity. I think we do a rather decent job of keeping eyes and ears open, much more than used to be the case when we were just regulators and doing tick boxing of various things. Of course, any system can, find some random shock and blow up. But I think I would be very surprised that we have not covered for most things or do not have early warning systems for most things by global standards. I think that even by Western banking system standards, and I have worked in, at the highest levels of Europe's largest banks. Let me say that our systems are actually very robust compared to pretty much everybody.
Thank you. Yeah, please.
What is stress test? What is telling? In the extreme scenario of something negative happening, how much will be the extent of erosion of the capital, which will bring it down below the regulatory requirement? So that is what we test. Question, it is based on a value at risk model. And value at risk model is based on historical flow of movement of variable relevant variables. And in global financial crisis, it was found to be flawed. What does it in simple language? It means if I did not catch fever for last 10 years, so I may not catch fever for the next 10 years. Is it realistic? No. So what was required to be done? What we have done in supervision. So a forward-looking stress testing thing has come up. I think it will come to next issues of FSR. Already DOS, you have started it, where one of the variable would be judgmental. So we have a concept of senior supervisor manager who is accountable and responsible 24/7. What is happening in a bank? In our time, it was principal inspecting officer who is responsible for that year's report. They are two different things. So his viewpoint, especially on those risks which are not measurable, like board oversight, management competence. So his judgment, they have a profound, like Yes Bank, problems in ICICI Bank. And all these are not because of any financial sector issues. You are purely corporate governance issues. The original wealth of humans are three as per economic theory. We are by birth greedy. We are by birth irrational. We are by birth stupid. That is why all economic models assume them away. The human beings are rational. So what is the point of assuming it? That means it is other way around, usually. Correct? So whatever may be much intelligent you are, one of these or two of these or three together will surface at one point of time. Yes Bank is a classic example. Okay? See, the common original sin of not getting your bank giving a loan for your real estate, which is common sense, will surface in you because of her irrationality and stupidity, which you are by definition you are. So that is the point there. So that is why stress testing world over is still not a reliable in this sense, because it is only by numbers. Numbers, again, another issue is there. We don't have thresholds. Just to quickly say, in our work, like in monetary policy, there is a threshold 4%, 2 and 4. What does that mean? If beyond inflation rises beyond 6, it will have adverse effect on growth. Below 2 also it will have adverse effect. That is called a threshold. That is very important. You cannot have absolute number. So global financial crisis could not be anticipated very surgically, as he told, because of the lack of threshold. And we, in Department of Supervision, RBI, like one I'm telling you, credit growth, contributor to GDP. So BIS has shown it as 25%. Means if credit grows by 25%, it will contribute very positively and productively to GDP growth. But that was known to be just like not backed by an empirical analysis. So we did it. And we found two things. All these stress testing, everything has got to be institution specific, macroeconomic condition specific, and time specific. You cannot have a stress test now and assume whole year it will run. And in one of the finding, I'll give example, like credit in India, if credit grows beyond 20%, also it is a, then we'll have adverse effect. If it is less than 10%, obviously we'll have adverse, GDP will not grow. Like why these NBFCs are falling? Because they take pride, we have grown at 52%. One NBFC CEO had told me, I told you will be crashing in 18 months. That is what our early morning, clear cut, and it crashed in 18 months. So that stress testing thing, so this has to be remodeled into a new concept called forward looking stress testing, in which numbers will not be absolute but threshold, upward, downward. This again, even at the cost of being branded Indian nationalists, to my mind, we are the first to do, because this we are the first to do. I have told in presence of Federal Reserve officers, Bank of England, they have not reacted against it. So by assumption, I am right. So as they would have challenged how India is the first one, we also have, correct. Repeatedly I have told before them, so we are the first. Like one thing, the 23 crisis in US cannot happen in India. In their presence, I had told. So what does that mean? So the ingenuity of Indian policymakers in general and RBI officers in particular is the best in the world.
Thank you. So, written by risk management experts. Some say it was market risk because interest rates suddenly rose and they were not ready for it because their securities value came down. And there's an inverse relationship. You hold a bond, interest rate goes up, the cost of your existing bond, which is say at 5%, if interest rates go to 7%, the value of that bond comes down. So bank is holding it, bank registers a loss. So those kind of things. Some say it is liquidity crisis because bank was holding assets that was not liquid enough to do a fire sale when there is a depositor run. So my question is that when these kind of things happen in 2023, not very far back, how do authors of FSR look at it in terms of assessing this domestic scenario?
So if you go back and look at what happened in that period, I think one of the points that Dr. Sanyal was saying is about you can do all kinds of stress testing and everything, but risk might pop up somewhere, right? So Silicon Valley Bank had large amount of unrealized losses. So unrealized. So essentially, what regulation tells you is that if you buy a bond, if you invest in government securities, you can bucket them into a couple of categories. Essentially, take it as two. Either you can hold it till maturity, then you do not have to mark to market it. Okay, you can just retain them in book value. And the other one is something called available for sale, which is you have to mark to market it. Now, in the Silicon Valley Bank had a simple business model, partly aided by the regulation at that point in time. So in US, there is something called a Dodd-Frank stress test, which is applicable only if a bank becomes $250 billion in asset size. Now, Silicon Valley Bank ensured that they always remain below that, so they are not stress tested. Okay, that's the first thing they did. But over a period of time, when the Federal Reserve started hiking interest rate at the fastest pace after the COVID crisis, there was large amount of unrealized losses on the asset side. Now, the problem for the bank doesn't stop there. I mean, a lot of banks have unrealized losses on the asset side. And for Silicon Valley Bank, the liability side was also concentrated. It was about 10 depositors accounted for almost 20% of the entire deposits. Now, who are these 10 depositors? Essentially large venture capitalists, technology firms. And I don't want to use the word Ponzi scheme. I really think that probably it is a business risk that is there in the banking system, is that anytime banking is all about trust. If you lose trust, then how much of capital, how much of a liquidity, nothing is going to retain the banks. Okay, we can prescribe capital to be 20-25%. Everything you invested in government security, nothing is going to happen to rescue the bank. So banking is a game of trust. So the moment you lose trust in banks, then that's what happened. Now the question is, how did we look at? Then obviously we had to look at the unrealized losses in the Indian books. We found that that wasn't that much. Even if we stress it, the capital wasn't going to erode that much. But more importantly, rather than on the asset side, we continue to look at on the liability side, because that's where the risk is. Actually, we tend to focus too much on the asset side in terms of what the assets are, because the run is always done by the depositors, and when they are concerned about the asset side, right? So you're looking at the deposits, how much of that is concentrated, how diversified are those. The challenge for the Indian banks going forward is going to be one where they are going to fight for deposits. I think previously they were enjoying sort of what you call as deposit franchise. Essentially, depositors gives banks something called a convenience yield. That means I'm willing to give you money because you are providing me safety. So for that, I'm giving you an yield. So instead of you paying me 5-6% of market rate, you are going to give me only 3 or 4%. That 2% is the convenience yield that you are providing to the banks, right? Now the banks are going to face that a problem, because as probably as youngsters who are more financially savvy, and as well as the equity market develops, as people put more and more money in mutual funds through SIPs and all, there is going to be a fight for deposits. There is going to be a fight for funds. Now, this again creates an anomaly in the system where a lot of commentators will write that, okay, suddenly banks don't have deposits. Banks always have deposits. Once money is created, it is there in the banking system. Just because I bought a stock or I put money in mutual fund does not mean that the bank is losing money. The only thing is the nature of the deposit changes. From a savings deposit, it becomes an institutional deposit. An institutional deposit is more easily can be withdrawn, and you have to pay a higher interest rate. So that is a challenge that the banking system is going to face in India, but it's a good challenge to have. You want to have a competitive banking system that fights for deposits. That means that makes them more efficient in the way they deploy those resources. So that's a good thing.
Thank you very much. And in the interest of time, so maybe now we can open, have one round of questions before we conclude. Whoever gets the mic. If you can provide the mic to the audience. So I think we're running out of time. So maybe we'll uh,
One question and then
one question and then we will.
whoever gets the.
So I would like to go ahead directly without fight. Again, I'm coming back to the risk capital question. I would like to ask about the same topic, which is most of the risk capital that is coming into India is coming out from outside, or most specifically from the banks. And we look at venture backable ideas. Most of the cash flow that is to be made is made it's to be made in future, as sir rightly said. So what possible outcomes that Indian entrepreneurs can look for? Because after a particular time, let's say Series A and B, there is not a lot of options available for creators or entrepreneurs, and they can neither go for listing, because listing is again not available for non-profitable businesses in India. So what can be a opportunity, or what can be a measure that we can look for this, for tackling this problem in India, where we can make availability of the risk capital?
Gentlemen, yeah. We'll take a bunch of questions and answer it in one shot.
I have one more follow-up. Can I just give it?
Yeah, I just had see, there are a few things which are possibly larger than just financial stability, which I thought maybe the panel can address. One is jobless growth, which seems to be for example, recently we had a Reuters poll of economists, which government kind of didn't agree. And then a second issue is at the state level we have a lot of these freebies competitively. Each government is fighting with each other to provide freebies, which have larger implications on the fiscals. And then a third is probably climate change, which is going to, have serious implication on stagflation, which would be, Professor Goyel's serious concern going forward.
Lady there can give mic to the lady there, and then we'll answer all of that.
Good afternoon. So, a strong resilience has been highlighted in the latest financial stability report. Is this the right moment for regulators to take on the uncertain risk of green finance more boldly? Can our current stability act as a cushion to accelerate the transition?
I think I'll just take the macro question about unemployment and link it to our talk here about reducing volatility in the economy, increasing stability. Now, we have a lot of different kinds of surveys, the ASU survey on small enterprises, the government portal, Udyam, which measures employment and, informal, etc. So all this is showing an increase in employment in the since 23, 25. And this is a period after a high and stable growth. So I'm not saying that's the only answer, but if we can reduce volatility and maintain a steady rate of growth, we will see improvement in employment. About risk capital, I would say that we are having innovations such as alternate investment funds and so on, and there are unlisted sort of sale of private equities. And at least because of the success of some entrepreneurs, a lot of foreign money is willing to come in. Some of the really high net worth individuals in India are also making pools of capital available for venture investing. And so I think we're moving in the direction. But the big, very important issue for new young entrepreneurs is good corporate governance. If there's one which tests whether a startup will become a unicorn or collapse, it is having good accounting systems and knowing how you're spending that money you raise, etc.
Yeah. So let me answer the same point that she made, which is that we need risk capital. There's no question about it. Historically, we have been, in some ways, perhaps too controlling of risk taking. For example, we don't allow listing of loss-making companies. My view is that once that company becomes large enough, and you can put some restrictions on it, which are reasonable, but I think at some level we should allow even loss-making companies to list. And after all, we all state that all those who are investing into the stock market are taking major risks. They should be aware of this. It is not a satta bazaar, and it is not a it's not a bank deposit that you're guaranteed to get back. If you took the risk in a loss-making company and it goes under, then that's the risk you took. So I think we need to be much more comfortable of risk-taking in our financial systems, particularly when we have protected, there are safe places to invest. They are called bank deposits. If you don't want to take those risks, please don't come here into this arena. So I personally think that we should, like AI has been allowed, we should allow any other new innovations in order to allow not just foreign money, but Indian money to go into all of those areas. And while I understand that you don't want, the relatively not so well off to sort of create chit fund, old style chit fund types of risk taking, but where it is reasonably regulated, where there's enough transparency, serious risk taking should be allowed. So that's my view. On jobless growth, I actually disagree that there is such a thing as jobless growth. Everywhere, there is no example in the world of sustained job creation without growth. It is a necessary and I would argue a sufficient condition. There is also no example in the world of sustained high growth without job creation. We used to not have good data on job collection, but we now do have what I would think is world-class employment data through PLFS. It clearly shows that lots of jobs are being created through growth. You can argue that our growth maybe should be higher, given that everything is stable, we should push for higher growth, and we can debate that. But I don't think there is any reasonable argument for making the case that our growth has been jobless. So for example, if artificial intelligence does cause job destruction, every round of technology has destroyed some jobs, but it has also created some jobs. So my thing is, keep growth going. I have reasonably good sense that it will create jobs. This debate about jobless growth, in my view, is largely a red herring and diverts away attention from what I think is important, which is to keep growth going.
Thank you very much. I think, yeah. So I think with that, we'll end this. So a lot of slice and dice later, one finds economy and financial system is a pacing juggernaut. Banks are capitalized, but behind it, we have also found that a lot of hard work has gone into crafting the growth story. With that, let's end the session, and I profusely thank our panelists for sparing their time. Big round of applause for them.
Good afternoon, everyone. Welcome to the closure of the program today. Before I'm here to propose the vote of thanks. Before, of course, proposing it, I would like to just look at what kind of juncture we are. At the one side, from 2025 February onwards, 100 basis points CRR has come down, and interest rate has gone down. And besides, the banks are actually sitting on the huge amount of liquidity, but they are not able to increase the credit because the credit actually is going down when compared to last year. But on the other side, the corporates are actually sitting on the higher amount of cash, which is 12% of their assets, and they're not actually borrowing from the bank, but they're actually moving to the markets. So given that different scenarios where we don't have the so-called twin balance sheet as of now, but like that the way that we had. So at this juncture, the current today's panel has thrown various dimensions on the financial stability conditions for India. So of course, at outset, on behalf of the Gokhale Institute and on my own behalf, I would like to propose a vote of thanks, and I would like to thank our Honorable Chancellor, Shri Sanjeev sir, for his valuable time and being part of the panel and providing valuable comments on the macroeconomic front. I would like to thank Professor Ashima Goyel for her time with the team, and has also giving the analytical touch the discussions that are required for understanding the financial stability from the macroeconomic point of view. We also would like to thank Professor Rabin Mishra for not only taking up the effort to arrange this, but also for making to be part of this panel and providing excellent remarks on regulation and supervision and the importance of the supervision when it comes to the financial stability of our country. And we'd like to thank Mr. Ayapan Nayer coming over here from the Reserve Bank of India. We would like to we heard that how the regulators think when they look at the financial stability from the outside. So we'd like to thank you, sir, for your valuable time, for your valuable insights on the financial stability. We'll also would like to thank Mr. Rahul Ghosh for his wonderful moderation and also driving the discussion towards the objective of the panel. Would like to thank you, sir, for your valuable time. And I also would like to thank our Vice Chancellor, Professor Umakant Das, for his support and also his presence throughout the discussions. Lastly, but not least, I would like to thank all our faculty, colleagues, non-teaching staff, and our dear students for their presence throughout the discussions and also for active participation in providing good questions. And at the last, I would like to thank all the people who are part of this event and who made this event grand successful. Thank you. Thank you once and again. Thank you.